Good morning, everyone. Welcome to today's Conversations with the Fed event on monetary policy. My name is Carmiana Matson. I'm with the Federal Reserve Bank of Minneapolis. And before I turn it over to our speaker today, just a couple of housekeeping items. Today's webinar is part of a series of presentations we offer under the Conversations with the Fed banner. And I've posted in the Zoom chat a link to our previous conversations if you'd like to catch up with those. We also offer a series of webinars on regional economic conditions, the next of which will be this Friday at 9 a.m. Central Time, and that will feature regional economist Ron Wirtz talking about business conditions in the 9th Federal Reserve District. We hope you'll join us for that event as well. There is a registration link in the chat on Zoom. We will be following up with all registered attendees for today's event via email next week to provide you with copies of the slides that Andrea will be presenting today, as well as a link to the video of this presentation. And we will have a few minutes at the end of the presentation for questions. So if you do have a question while Andrea is talking, please type it in the Zoom chat. I'll be posing those questions to him verbally, and you can post those at the end of the presentation, or if you've got a question as he's speaking, as something arises, you can feel free to throw it in the chat as he's talking. Lastly, we would love to get your feedback. At the end of this session, you should receive a pop-up survey in Zoom when the session ends. Quick 3 questions asking you what you thought of this event. And with that, I am going to turn it over to today's presenter, who is Andrea Raffo, our Senior Vice President and Director of Research at the Minneapolis Fed.
Thank you, Carmi, and welcome everybody to this event. Today we are going to share some insights on the question, are higher interest rates here to stay? Jeff Orwick and I published an essay yesterday on the Minneapolis Fed website, and today's presentation will basically summarize the key points of that essay. And as Carmi said, this is really meant to be a conversation. So please let me know if you have questions as we go along. Oops. Let me first remind you that obviously the views are only those of the authors and do not reflect the views of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. Well, if you have picked up media, newspaper articles over the recent months, you have definitely seen big headlines about the era of historically low interest rates is over. Higher interest rates are here to stay forever, so on and so forth. And there is a lot of discussion about what are the prospects for interest rates going forward. And often these articles mention this concept of the neutral rate, which is a key element to gauge whether interest rates are going to be higher for longer or forever or not. So, for example, in a recent Wall Street Journal article, Greg Ape summarized the projection published by the FOMC by noting that some officials hint that rates may be higher, not just for longer, but forever. The so-called neutral rate, which keeps inflation and unemployment stable over time, has risen. So it adds that this matters for any investor, business, or household whose plans depend on interest rates over a decade or longer. So what I intend to do today is to basically provide a little bit of a motivation as what is Greg responding to, and then cover a little bit what is this neutral rate and what are the prospects for the neutral rate. So Greg was basically reacting to a chart that was published in the Survey of Economic Projections by the FOMC, which was summarizing the views of the FOMC participants, the 7 board member governors and the 12 presidents of the regional Feds, on what the federal funds rate is going to be in the long run. So 4 times a year, the FOMC publishes projection over the interest rates, both in the short term and in the long run. And one observation that emerges from the most recent projection, the December 2023, for example, is that the longer run is still on average expected to be around 2.5%, as you can see from the blue line. But many dots are now moving up relative to, for example, what the committee published in December 2019. So more and more FOMC participants are seeing the possibility that interest rates will be higher, not only in the short term, but also in the longer term. Some participants are as high as 3.5%, which is very different from the central tendency of 2.5%. So the outline for today, as I was previewing before, is basically I want to first define this concept of the longer run neutral rate of interest, trying to provide some motivation as to why it is important. And then I'm going to address the quintessential question: is it going to be high or low in the future? And our tentative answer is going to be no, most likely. Let me define this concept of the neutral interest rate. It's basically the level of the policy rate, the federal funds rate target, so the monetary policy is neither expansionary nor contractionary. Essentially, you can think of it as the interest rate that prevails when the economy is in balance. The unemployment rate is low and near the structural unemployment rate level, and inflation is a target at 2%. When you have this condition in the economy, there is an interest rate that prevails, which is what we call the neutral interest rate. And as I was indicating before, the central tendency for this interest rate remains as 2.5%, which is the blue line in this chart. And you can think of that 2.5% as being a contribution of 2% inflation target and a 0.5% real interest rate. Why does it matter? Well, what the central bank does when there is a recession or when there is a boom or when inflation is high is essentially to vary the policy rate, the federal funds rate target, above and below this neutral level, so that it can achieve a stance on monetary policy that is either restrictive or accommodative. Here, for example, what I'm plotting is the December SEP, the Survey of Economic Projections from the FOMC participants. Each dot is basically the summation of what a regional bank president or a board member expect the federal funds rate to be in 2023, the very first column, 2024, 2025, 26, and in the long run. The blue line, as I was showing you before, is basically the 2.5 neutral level for interest rates. So as you can see from the red line, which is the central tendency, like you can think of it as the median of all the FOMC participant projections, the red line is much above the blue line, suggesting that as of December, the FOMC intended to have a restrictive monetary policy stance in order to facilitate demand supply to come into better balance and inflation to go towards target of 2%. Now, why does this neutral rate, which is the very last column labeled as longer run, why does it matter? Well, right now, the FOMC assumes essentially that the neutral rate is 2.5%, so a current policy rate of 5.5 is pretty restrictive. However, imagine for a moment that this neutral rate is actually much higher than 2.5%. At that point, the vertical distance between the red and the blue line is much smaller. Monetary policy is much less restrictive than the committee intends to. So that's why taking a stand on what this neutral rate is has a direct implication on whether monetary policy is restrictive or accommodative. If there are no questions about what the neutral rate of interest is, I would like to next turn to the question of what are the prospects for this neutral interest rate. What I'm showing here, obviously this neutral real rate is basically an economic construct that we don't get to measure in the economy. So that's why there is uncertainty over whether it is high or low. And there are various approaches to try to provide estimates about this neutral rate. What I'm showing here is a specific estimate produced by Holston, Laubach, and John Williams, the president of the Federal Reserve Bank of New York, that basically traces the evolution of this neutral real interest rate since the 1960s. And what emerges from this chart is that the neutral rate actually has been steadily going down over the past 50 plus years. You see some ups and downs. For example, in the mid-1990s, you see that it had almost a decade of upward trend. But then overall, this neutral rate is estimated to be much lower than what it used to be in the 60s. And give or take, this interest rate has basically declined, according to this estimate, by about 4 percentage points. So this change is sizable. As I was saying before, this is an interest rate that we don't observe. We kind of had to come up with estimates, and there are a number of approaches to provide a sense of where this neutral rate is. Some rely more on financial market data, surveys, others rely on complicated models. But overall, independent of what the approach specific details are, there is consensus that this neutral rate has been declining since the 60s. So the magnitude of the decline may be different across the studies, but more or less, they all agree that it has gone down, and it's gone down by a significant amount. The next question then is to try to provide a sense of what are the factors, the drivers behind this decline in the neutral interest rate. And the economic literature has put a lot of emphasis on 3 specific factors: productivity growth, demographic transition, and what we call the demand and supply of government debt, or safe asset. So one way to think about the neutral rate and its prospect is to ask the questions, okay, we know that these 3 factors have been contributing to the decline of the neutral rates over time. What are the prospects for these 3 factors going forward? And this is what I'm going to do next. So I'm going to start from productivity growth. What I'm showing here, the vertical bars are basically average growth rates in total factor productivity. This is a measure produced by the Federal Reserve Bank of San Francisco. And as you can see, in the 1960s, between 1960 and 1972, productivity growth was very high. It was close to 2%. Then it went down through the 70s and the 80s. It experienced a brief surge in the 1990s, consistent a little bit with the dynamics of the neutral rate that we saw before. But then it has been going back to very low levels, basically starting in the early 2000s. And as you can see, the average between 2003 and 2019 was very low, was barely above 0.5%. So very much lower productivity growth in the 2000s and 2010s than in the 1960s. So one relevant question is whether these productivity developments will persist going forward. What I'm showing in the red bar is the average productivity growth between 2020 and 2023. And as you can see, the pandemic as of now has not delivered the productivity boom. On the contrary, if anything, there is a little bit of a recognition that productivity took a hit over the pandemic years. Now, there is quite a bit of uncertainty about these estimates. The economy went through a lot of shifts, and we don't know what will happen next. Work from home, for example, is changing the way we organize businesses, might result in an increase in productivity going forward. Similarly, the pandemic has been associated with major reshuffling global value chain, for example. So large corporations are, as of now, thinking of how can we increase resilience and improve the efficiency of global value chains, which might result in higher productivity going forward.
And Andrea, could you just
yeah.
back up for just a minute and tell us, what are you measuring when you say productivity? Is that the amount of goods that we're producing? What exactly is that productivity?
So you can think of productivity as how good we are at producing the same amount of goods with fewer input. So it's a measure of efficiency of the economy. If you think about what a great innovation does, it allows you to produce new goods or more goods with the same amount of input. So it allows you to save on in cost while producing the same amount of input. So that's really a measure of efficiency. And for example, what I was going to share as the last thought about going forward is that AI is currently the big wildcard discussed in terms of what are the implications for productivity going forward. It might be that AI turns out to be a major shift in the way we organize work, in the way we produce goods and services, such that we experience another big increase like in the mid-1990s. That said, what we mentioned in the article is that, in the essay, is that we have had a number of enhancement in terms of software and technology that have not necessarily resulted in a big increase in aggregate productivity and efficiency. So there is quite a bit of uncertainty in terms of what the prospects for productivity are. And ultimately, we care a lot about productivity because this is one of the key sources of long-run increase in income, welfare, well-being of people. So since higher productivity translates in higher growth, you can think of productivity as having a direct implication for interest rate. When you have a big discovery, it's a good time to make a lot of investment. So the demand for investment goes up, and that drives up interest rates. So in general, countries that experience high productivity growth tend to have higher interest rates.
Do they also, Andrea, experience then higher unemployment? As your productivity grows, do you need fewer workers and thus have higher unemployment?
Interesting that you mentioned that. In general, the experience is that when there are big discoveries that increase standard of living, you don't observe big increases in unemployment. There is some reallocation of labor across sectors, but economies that grow a lot because of higher productivity tend to have very healthy labor markets. So it's a good thing. Let me now turn to the second factor that contributed to the decline in interest rate, which is the demographic transition. And this has been quite a bit in the news for the past decades, actually. And a number of studies have been published out there trying to understand the implication for the economy of changing in demographic. And here I want to put emphasis on two dimensions of the demographic transition. Excuse me. The first one is the fact that we're experiencing a significant decline in population growth rate. This is the panel on the left. Here I'm showing the US and Europe. As you can see, Europe actually had a decline in population growth rate well before what the US experienced, but more or less there is a common trend for growth rates in population to be lower than 50 years ago. Excuse me. The panel to the right summarizes another interesting development for the demographic transition, which is the observation that life expectancy has actually increased quite a bit over time. For people living in the 50s, both in the US and in Europe, life expectancy was about 70 years. And now we are reaching levels that are much higher than back then. For the current generation, for example, life expectancy is getting close to the 80s. So a number of academic studies have actually investigated the implication of this demographic transition for the economy and for interest rates. And why is this important? It is important because population growth and demographic transition has a number of implications for the macroeconomy. First, you can think of it as when you have a lower population growth, you basically end up having a lower interest rate, pretty much for the same reason as a lower productivity growth, translating to a lower interest rate. In a sense that if there are fewer workers around, there is less of a need to have capital to produce goods, and that reduces investment. There are also other channels that have more to do with the life cycle profiles of individuals. When life expectancy increases, this translates into a change in what is called the dependency ratio, which is how many old people are around in the population relative to the young people. And many academic studies have shown that this effect tends to lower the interest rate for two reasons. The first one is that if you live longer, you need to have resources for the old age, so you end up having to save more for the old age. The second one is that we have observed that when people get into the old age, they actually tend not to reduce saving as much as standard economic theory would suggest. The standard economic theory would say when you're young, you borrow because you want to buy a house and so on and so forth. When you get old, you sell your asset and you start consuming more. It turns out that there is plenty of evidence that actually both health risk and bequest motive give incentives for the old cohort to actually increase savings more than the standard theory suggests. This is to say that essentially, again, there is higher saving around than expected, and this reduces the interest rate. Last but not least, I already made the point with the chart showing US and Europe that this is not a US specific phenomenon. I'm going to show you that this is actually a global phenomenon. What I'm showing here is actually the same chart that I presented before with projection from the UN for population growth on the left and life expectancy on the right for US and Europe. As you can see, the projections are for growth rate in population to diminish further and life expectancy to increase even more. So by this picture alone, you can tell that probably these forces that have been the most important factor contributing to a decline in the neutral rate over the past 50 years are probably likely to stay there, and if anything, to put additional downward pressure on interest rates. Let's add to that this is a global phenomenon. What I did in this chart is to integrate the US and Europe lines with pictures for China, India, that are emerging market economies that currently have population rates that are actually much higher than typical advanced economies. But as you can see, the transition is happening very fast. These population rates have been steadily coming down over the past few decades and are projected to fall even further. And life expectancy in these countries is also increasing and is projected to increase further. Given that in today's economy, basically savings and investment balances are not a country-specific phenomenon, but savings can move around across countries, you could expect that the excess in global savings due specifically to demographic transition, is likely to put additional downward pressure on interest rates. Let me now turn to the third factor, which is the demand and supply for debt, public debt. And here I would like to make, there is often, you read a lot of commentaries about debt is going higher in the US and many other countries. During the pandemics, governments had to provide support for the economy, and they ended up borrowing quite a bit to finance those programs. That channel tends to increase interest rates. Here, I would like to put a different perspective on public debt dynamic that looks at the importance of public debt as a safe asset. What is a safe asset? A safe asset is basically an asset that when there are bad times, still doesn't lose value. And public debt, and specifically US public debt, is actually currently the global safe asset. Whenever there are big global recessions, big global moments of uncertainty, you see domestic and foreign investors actually purchasing US debt. And that is the status of global safe asset is based largely on the notion that the United States has great fiscal capacity, financial development is at the top of the global frontier, and the Federal Reserve has credibility to back the dollar and thus the financial system. What we are seeing over time is also that the demand, the global demand for US debt has steadily increased for a number of reasons. First, many emerging market economies do not have an asset that is safe. Domestic public debt is not perceived as safe as the US debt. So what these emerging market economies have been doing over time is to accumulate reserves that they can access in recessions or in bad times. And they've accumulated these reserves exactly in terms of US public debt. Former Chair Bernanke provided this a very early elaboration of this idea in what he called the global slaving glut. There have been a number of academic studies that actually have documented and provided insight about why that's the case. But we know that the US debt is actually considered like the quintessential global safe asset. Then there have been a number of changes in financial regulations that have increased the safe asset role of the US. In general, as I was saying before, in bad days, in bad states of the global economy, US public debt tend to be the preferred store of value, or investors run to accumulate US public debt.
Do we need to worry, though, Andrea? There's a questioner in the chat asking about whether we should be concerned about which countries are holding significant portions of that debt, like China or Hong Kong.
Well, from the perspective of the safe asset logic, what you worry about is the US losing the status of preferred safe asset? And that has largely to do with the US ability to maintain sound fiscal positions, US ability to be at the frontier of financial development, and the credibility of the Federal Reserve. And with that, especially on the first point, you read a lot of commentaries nowadays about the fact that the level of debt is too high. And as I was saying, there is quite a bit of uncertainty of whether that per se will elicit higher interest rates. What I'm going to try to argue is that for now, this effect is likely to be small, and I'll provide a couple of caveats. What I'm showing in this chart is the neutral rate, the same neutral rate that I was discussing earlier in the presentation, from 2000 to 2023, and US debt held by the public relative to GDP. Two observations kind of stand out. The first one is US public debt was about 40% in 2007-8 before the global financial crisis, and doubled in the following decade as the government had to deal with the fallout of the global financial crisis and the Great Recession. That said, the neutral rate kept falling and remained pretty low. So this idea that higher debt elicits lower interest rate is kind of partial in the sense that it doesn't take into account all the other developments that are happening in the economy. So while directionally that might be correct, quantitatively it turned out that at least post-GFC, we have seen a massive decline in interest rates, even if debt increased. Now, if you focus on the most recent years, the public debt is higher than in 2019, it's currently around 95%, but the change is very small compared to the big change that we saw in the GFC decade. So in that sense, it's difficult to imagine that the current increase will dramatically change the level of interest rate going forward. That said, as I said before, I would like to provide two caveats. What matters for the sustainability of public debt is actually what are the prospects for that going forward. So there is no question that you need to have that public debt remains on a sustainable path. And for example, the recent projection published by the CBO showed that the absent changes in legislation, US public debt will increase to 115% over the next 10 years. So it is important that administrations ensure that there is a sustainable path for public debt going forward. And that is important in the context of what we are discussing, even more because right now US public debt is perceived as the safe asset. But if you were to reach very high level of debt, it could undermine investors' confidence on the status of safe asset. The second caveat is that we just came through a period of high inflation, which resulted actually in a state of the world in which US public debt lost value in the eyes of investors, because basically higher inflation, given fixed interest rates that were paid when issued, reduced the real value of that. Since investors do not want to have these losses, they might start requesting compensation for this type of risk going forward. But this ultimately will depend on what is the probabilities of observing high inflation going forward. And on this, the Federal Reserve remains committed to bring inflation down to 2% and keep it at target going forward. So let me conclude. I posed the question, are higher interest rates here to stay? Focusing largely on the longer run path for interest rates. So not this year, not next year, but looking more at what is this neutral rate going forward. And the tentative answer is most likely no. We are likely to see a return to the pre-pandemic years in which the neutral rate was basically pretty low. So the 2.5% long-run neutral rate federal funds rate that the committee anticipates, it seems to me a pretty reasonable assumption. The main argument to support this prediction is that essentially, if one looks at the factors that contributed to 50 years of reduction in interest rates, Those factors are likely to stay here. In particular, there is plenty of academic literature that suggests that the demographic transition accounts for the bulk of the decline in interest rates. And the prospects for an unwinding of the demographic transitions are actually pretty slim. If anything, the demographic transition is likely to become more and more a global phenomenon that will put downward pressure on interest rates. Finally, I raised a few sources of uncertainty. Like, as always, predictions are almost as a guessing game, educated guessing game, but the world can always surprise us with unanticipated developments. And two that are currently pretty much in focus are, one, will AI result in a new productivity boom? If that's the case, we're going to experience much stronger growth, much higher investment, and with that, much higher interest rate. The second one is about the sustainability of public finances and the notion that US debt has increased following the last two recessions, the global financial crisis and the pandemic. There is a level of debt that could undermine the perception of safety. Right now, the US debt is the preferred global safe asset. We want to make sure that it remains so. And with that, I'm open to take questions.
Well, with that sentence you just ended on, there was some conversation in the chat asking, well, how do we know what's a sustainable level of US debt? When would it get to be worrisome?
Oh, that's $1 million question. Surprisingly enough, there have been a number of academic studies trying to identify what's the optimal debt level that one can sustain. And there is quite a bit of disagreement in terms of what the specific number is. It gets even more complicated for the US exactly because, differently from other countries, US debt plays this important role for the global economy. So given that this additional demand from the global economy for US debt, an implication of that is that the maximum level of sustainable debt is somewhat higher than a typical country that doesn't experience those benefits. The caveat that I emphasize is you cannot take that for granted. So it's important that the debt trajectory for the United States remains on a sustainable path. The CBO has a number of scenarios. Obviously, is very much involved into providing scenarios for debt sustainability. Ultimately, though, this is something that the Federal Reserve doesn't control. It's fully in the hands of Congress and the administration. So,
thank you. We have lots of questions in the chat. We will only have time to get to just a couple of them. A lot of the questions in the chat are from folks I would consider to be Fed followers. I think we've got a lot of economists out there. We've got a lot of folks with some pretty detailed questions, but I'd like to back up a little bit for the listeners out there who are maybe novices to monetary policy and who do their best to follow Neil Kashkari's essays and read the articles in the paper. There are a lot of different rates that you mention, that Neil mentions in his essays: nominal rates, real rates, long rates, short rates, forward rates, neutral rates. That's a little overwhelming for the average consumer who wants to know, how does this impact my mortgage? When can I refinance? I want to buy a car. When's a good time to do that? Can you make that connection for us?
I will try. Let me go back actually to this chart. As I mentioned before, this is essentially a summary of the projections of all the FOMC participants on how they see the evolution of interest rates going forward. Obviously, they are providing projection on the policy rate, but when the Fed changes the policy rate, all sorts of rates in the economy are affected by it. So according to the central tendency of this projection, interest rates are expected to decline over time and to return to what is a normal neutral level sometimes after 2026. So this is the path that the typical, the central tendency of the FOMC expect to observe over the next few years in order to ensure that inflation that's currently still elevated returns to 2%. Then obviously this path is predicated on how we see the economy now and how we see the economy evolving over time. If there are developments that actually change the course of the economy in positive or negative directions, this path will be adjusted as needed. But this is essentially, you can interpret this path as giving you a sense of what the best prediction as of now is for the policy rates this year, at the end of this year, at the end of next year, at the end of 2026. And with that, you should observe a number of interest rates faced by consumer, by firms, by government, to move in lockstep with the federal funds rate.
Well, and you just mentioned things that could impact that projection. There is a questioner asking about, what are some of those things that could have a major impact on productivity levels? You mentioned potentially AI, but what are some other examples? Why was it so much higher in the 70s, for instance?
So I interpret that question as having two components. What are risks? And it's easy to, for example, go back to a couple of years ago when we suddenly woke up one day and we found out that Russia had invaded Ukraine. That was a major geopolitical event. Back then, the FOMC had a similar projection for interest rates or a certain path for interest rate in mind, but that unexpected event changed completely the assessment of what is going to be the evolution of the economy going forward. The result of that event, for example, was that commodity prices went through the roof, and with that, ag prices went through the roof. Global value chain got another major disruption, and with that, we got another increase in inflation. The response of the FOMC to that event, which increased inflation and provided quite a bit of uncertainty and hit to economic activity, was actually to quickly increase interest rates to make sure that inflation returns to 2%. So these are the scenarios, the shocks, the developments that we try to anticipate. We run simulations in terms of what would happen if, and then you can see them as trying to prepare the policymaker for, in the event that we observe this configuration of development, probably policy should be adjusted in this direction or in another direction if it is a different configuration of that. As for productivity, I think there is quite a bit of uncertainty right now. As I mentioned before, the discussions about work from home, configuration of cities, and to what extent this is changing the way we produce goods and services are still current, and there is a very little sense of what would be the long-lasting effect of this shift. AI is pretty much a wild card. We just had an interesting conversation with an expert from Cornell that gave us a perspective from the computer science field on what AI is doing and how they see AI. And his feeling were, well, AI feels very much like 1995. It has the potential of unleashing a major revolution in the way we operate, but we don't know yet. So if that's were the case, that would mean very positive prospect for the economy. Ultimately, as we discussed before, productivity is one of the key drivers of long-run living standards. So, but we don't know yet.
Well, I'd like to close with this last question here, since you just mentioned long-run productivity standards. You showed us that the birth rate is declining, our society is getting older, we're having less productivity. Those things are providing downward pressure on interest rates, which seems good, But for the economy to grow in general, those things are bad things, right? Having a lack of productivity and a lack of population growth. So there's quite a bit of conversation in the chat around immigration and what role that needs to play in building our economy.
Yeah, that's a very important topic. It's again one of those topics that is more in the hands of Congress administration. The Fed doesn't control immigration policy. But in terms of economic intuition, I think even when we go around the district, we hear a lot about labor shortages and firms struggling to acquire talented workers, limits to increasing the workforce. So in a world in which the size of the workforce is expected to shrink, immigration would obviously be a channel through which you can actually sustain higher level of production, a higher level of investment, and so on and so forth. That said, what is the best immigration policy, how we should go about it, those are all in the domain of governments around the world, actually, not central banks. But directionally, yes, increasing the workforce through immigration would be a positive development for the aggregate economy. And as a matter of fact, we have seen that in 2023, inflation decreased much more quickly than many expected. And a big chunk of that had to do with the fact that the labor force recovered faster than many expected. A big chunk of that labor force recovery was an increase in immigration. So you can see already directly there some of the benefits of diminishing the cost of labor shortages through immigration.
Great. Thank you so much for joining us this morning, Andrea. We appreciate your talk to us today, and we appreciate all of you who clicked on this link and attended. We will be following up with all of you next week. We will send you an email that has a link to Andrea's slides as well as a copy of the video to today's presentation. And we hope that you will, upon the close of this Zoom, click our quick 3-question survey, give us a little feedback about this event and what kinds of things you'd like to see us do in the future. And we hope to see some of you back again this Friday at 9 a.m. Central Time for a presentation on the regional economy in the 9th Federal Reserve District and how our businesses here in the 9th are faring. Thanks so much for joining us, everybody. Have a great day.
You, Carmi, and thank you all for joining.